Welcome everyone. We'll get started in about a minute. All right, so welcome everybody. Let me just close that. There we go. So hello everyone. Today we will be talking about a few facts that I've mentioned on a few occasions, at least some of them I've mentioned on a few occasions in previous sessions, a few facts about the stock market. And is it all just about, if you were to remove a few good days from the market, would the market never really go up or would barely go up? Is there any truth to that? And again, to what extent does that actually impact the market? So without further ado, let's get started. So you've probably seen this or a variant of this particular statement in the past. So time in the market beats timing the market. So it seems like one of those platitudes that some people just like to say just to sound important or smart, but it's actually quite true. My contention is that it is quite true, but I'll show you the data today, and at the end you tell me if time in the market actually beats timing the market. So time in the market simply means being invested in being buying stocks, becoming a co-owner of all those stocks, whether you're doing it by buying individual stocks or whether you're doing it the slightly lower risk route of buying an ETF, for instance, that holds tens, hundreds, or even thousands of different stocks. So this literally just translates to, for how long have you been invested in market? And basically here it says that the longer you are invested in market, it will beat anyone trying to guess when is the optimal time to buy, when is the optimal time to sell, etc. Right? So again, my contention is that this is very much true. So basically being invested, just buying, using dollar cost averaging, DCA, whenever you have the money, buy basically into the market. It's probably your best bet moving forward for the vast majority of individuals, unless you happen to be, an expert, or unless you're doing this full time or consecrating or devoting a significant portion of your time. The vast majority of people don't have the time to check their stocks 15 times a day and analyze trends correctly and all of that stuff, right? So if anything, the more you look at charts, the more you're trying to guess when the market will go up versus fall, the more likely you are to just buy or sell just at the wrong time. So let's have a look at in terms of why does it make more sense to be basically invested for the long term. Well, what happens if you miss a few good days in the market? And keep in mind, a few good days could happen at any point in time. You do not know if the best day of the market or one of the best days in the market for 2020 is taking place tomorrow, is going to be taking place in 2 weeks from now, or took place a month ago, right? You don't know until the year is over, right? So the long-term rate of return, right, of a balanced and diversified portfolio is 7%. I keep on, throwing that number around on many, many occasions. Right? So that's your rate of return. And let's say a nice number I usually like to use is what if you were to save $13.43 a day every day and invest that money for 40 years. All right. So the reason I like to use that specific example is basically $13.43 multiplied by 40 gives you roughly, multiplied by 7, first of all, gives you roughly $94 a week. And then if you were to multiply it by, again, during the whole year, it's roughly $4,900. Now, keep in mind, in Canada, the average income per individual before tax is around, again, depends where you live, but it's roughly $46,500. So if you were to save $13.43 per day and invest that money over 40 years, right? At this 7% rate of return, at that point in time, well, what would you end up with? Anyone that has been here in previous sessions or has heard me talk about this will already know the answer. But here's basically this compound calculator that I like to use. And yeah, I'm going to post this in the chat. Again, I'm sure you all have seen this one before, but if you haven't, I'll also include it in the description of this video once it's done. So yeah, you end up retiring with basically over $1 million. So again, this is not the fast way, the overnight way of becoming wealthy, but most experts suggest that for the vast majority of people, you could probably cut about 10% of your budget without minimal repercussions on your life, especially if you happen to have roughly, make about the median or make about the average income. So $13.43 a day. That's basically roughly $4,900 per year. Which, yes, it's about 11% or 10.89% or thereabouts of the average Canadian income. So it's right around that 10%. So people should be able to set at least that amount aside with proper budgeting, etc. Right? So there's literally no reason why the average person, average Canadian, earning the average salary shouldn't be able to retire with at least $1 million. Literally no reason other than them finding excuses for not saving and investing. And sure, if you're in the lowest possible income group, you're an incredibly low socioeconomic group, then yes, it's a lot tougher to basically, if you're a single parent and you're trying to juggle 2 or 3 part-time jobs and also maybe taking some online courses at the same time and raising a family and all of that. Yes, there are certain exceptions, but my point is there are so many people that are doing and earning way more than the average income, and they don't retire anywhere near with $1 million, right? But why might that be? Yes, for sure. Some people will save their money instead of investing it, right? And we've seen in previous sessions when I was talking about, the difference between saving and investing. Saving is really short term. You want to do that. You want just to have a few months worth of emergency savings. As your assets grow, probably even that is not necessary. You could just rely on the passive income that your investments are earning, or even just have a line of credit as a backup as your assets are growing. Initially, though, when you don't have anything, you definitely have at least 3 or ideally 6 months worth of emergency savings. Pay off those high interest debts first, then start investing, right? But again, we've seen that before. So the long-term rate of return of a balanced diversified portfolio, and just for reference, again, if you weren't here before, this is a 60-40 portfolio, right? So what that means is 20% would be invested in Canadian stocks, right? 20% in US stocks, 20% in international stocks, right? And you can do this the easiest for the vast majority of people, just with the number of ETFs. That's it. Then this 40%, this would be for your safe assets, right? So this could be anywhere from about 20 to 25% in bonds, a mix of government, corporate bonds, etc., treasury bills, and then 15 to 20%, depending on what percentages are going up here, in preferred shares. Is this the only way to invest? No. But for the average person that already has a ton of things to do on a daily basis, this is one of the easiest ways to invest, and without having to time the markets, without having to figure out what is the next, next Google or next hot stock or what have you, right? So again, all of this stuff we've seen, and this basically doing this will yield you roughly 7% per year. It's not a guarantee. It's not going to be every year. Some years you'll make substantially more. Some years you'll make substantially less. Another fun fact to remind you of is that drops of roughly 10% occur at least once a year, right? So the market corrects by at least 10% at least once a year on average. So again, sometimes 2 or 3 of those corrections happen in the same year. Other times you can go 4 or 5 years without a single 10% drop. But on average, it's roughly once a year, or slightly more often than once a year. The markets also drop by at least 20% or more at least once every 5 to 7 years. Okay? So these are all statistics that are incredibly important to keep in mind in order for the rest of this to make sense. So what happens if you were to miss the 10 best days of the market, right? Again, this is a rough estimate. These numbers will vary a little bit from one year to the next. So some years when you miss the 10 best days, it'll drop substantially more than this. Other times substantially less than this. But basically, if you're missing the top 10 best days of the stock market, your average balanced portfolio return drops from 7% to 2%, right? So you have a full 5% drop. Now you might be thinking, well, who cares? It's just 5%. Yeah, but keep in mind, if you keep on doing this on a relatively consistent or constant basis, that severely hampers your return. So keep in mind, this is with a 7% rate of return, right? So you're still saving the exact same amount in both situations. So now let's remove this, or let's drop your rate of return to 2% instead of 7%, right? How much money do you end up with? Again, assuming you were to do that every year and every single year lose out on those 10 best days of the year, right? So how much would that exact same amount of savings and investments result in? Well, you only retire with barely $300,000, right? That's a very, very, very big difference in the quality of life you could expect retiring with just over $1 million to not even $300,000. What if you were to miss the 20 best days? Well, then a balanced diversified portfolio will drop all the way to roughly negative 0.5%. Or, I mean, honestly, in all fairness, you could consider this a neutral rate of return, right? So you'd pretty much not make any money, right? Because again, some years this will be slightly positive, some years this will be slightly negative, depending on what those best 20 days look like. How about if you're missing the 30 best days in any given year? Well, on average, your balanced diversified portfolio, which again is the portfolio that works for the vast majority of people best, would actually net you a net loss of 2.5% per year every year. So not only would you be losing out because you're not growing your investments. So in this case here, you'd barely keep track. You'd barely match inflation. So in real terms, you're not really making any money. And keep in mind, these days, savings accounts, checking accounts, if you're lucky, they'll pay you 2%. Many pay far, far less than this. Even guaranteed investment certificates pay less than that. So GICs also pay less than that, right? Now, how about if you were to miss the best 40 days of any given year? Well, your net return of a balanced diversified portfolio would be roughly negative 4.5%. And finally, if you're missing the 50 best days, your net return is a negative 6%, sorry. Because it fluctuates between about 4 and about 6.9% on average in the negative. But these are just the averages overall. right? So sometimes you might be investing in the correct thing, but just because you're not invested for long enough, or you're trying to, kind of jump in and out of that exact same investment, which is the correct investment for most people, not according to me, according to research, according to the experts, right? I'm not a licensed professional, okay? So don't take my word for it. Just again, the data is out there. I've discussed this in past sessions, and I'll talk about this much more in future sessions as well. But yeah, so it's incredibly important to be invested for as long as you can throughout the year, and then year after year. Because think about it this way: if 1 year you're missing out the 10 best days, well, that year you just made 2%. You're missing out the 20 best days. Well, that subsequent year you just lost 0.5%, right? Whereas if you're staying invested on average over long periods of time, you'll have an average compound rate of return of roughly 7%. So this is that the JP Morgan asset management study that I've covered in the past, but it's important bringing this up again, right? So the way this works, so they've looked at the Russell 3000 index. The Russell 3000 index basically makes up the 3,000 largest publicly traded stocks in the US. Okay, so the 3,000 largest publicly traded stocks in the US. They overall make up roughly 98%. They make up roughly 98% of the entire market. So, and whenever you have 98% of something, you pretty much have the entire something. It's very representative in that regard. So, how should we interpret this? So they've looked from 1980 to 2014. So over a 35-year period, they've looked at basically 98% of all US stocks. Okay? And they looked at how well have those stocks performed compared to the market average, right? Now you have to keep in mind that stocks, the average market return, and the way that stocks are distributed in terms of how well some companies do compared to others, and how poorly some other companies do. It's not a normal distribution. You don't get a standard, bell curve that you'd expect to have something like this, where most of the companies would be somewhere in the middle. You'd have very few extreme losers, very few extreme winners, right? It's a very skewed distribution instead. You don't have it like that. So here they're looking at whatever the market return, the average market return was over those 35 years for the Russell 3000, right? So any stocks that have performed just as well as the Russell 3000, they would have a time-adjusted lifetime price return on each stock versus the Russell 3000. The difference would be literally 0% because they've done just as well as the market average did, right? And by the way, so the Russell 3000 is made up of 3,000 companies, but those 3,000 companies change from 1 year to the next, right? Because when a company declares bankruptcy and falls out of favor with investors, at that point in time, that particular company, either the bankrupt or even if they just lose a significant portion of their value with minimal to no recovery in price, that company will be eventually replaced with a different company on the Russell 3000. As a result, at any point in time, you have roughly 3,000 companies making up the Russell 3000. But overall, over those 35 years, many more companies made up the Russell 3000 over that entire time period, over those 3.5 decades. Because the 3,000 companies that made up the Russell 3000 last year might be slightly different than the ones that make it up right now, and will be slightly different than the ones that make it up 2, 3, 4 years from now, right? So because of that, the total number of stocks that are in those distinct categories are, quite high. The numbers are quite high. So for instance, here you have about 2,000 plus, around 2,000 stocks that basically underperformed the market average by 100%. So they've only returned half as much as the market average has returned over those 35 years. Now you might be thinking, well, I thought that the most a stock could lose is 100%, not 450. Yes, sure, but keep in mind here you're not looking at the actual returns of individual companies or even at of average returns of the entire market. You're looking at the relative returns of those companies compared to the market average itself, right? So because of that, it is possible to be trailing the market average by multiple 100%, right? So if the market average return was 600% over those 35 years, and the particular company that you purchased, the individual company you purchased here, its return was only 150% over 35 years, but the market average return was 600%, then obviously 600 minus 150 gives you a negative, so the 600% return of the market minus the 150, you have you're missing out on basically 450% return. So you're trailing the market by 450%. Okay, so this is what this means, right? So you see how many companies are trailing the market average and even the market median. So the market median is 50% of companies have performed less well than the market median. 50% of companies have performed better than the market median. And finally, here at 0, that's the market average. And then this green line, that highlights the extreme winners. We all would like to buy the next Microsoft, the next Google, the next Facebook, the next Amazon, when they're still in their infancy and very few people have bought them yet, right? We all would like to be looking at those stocks and buy them to make multiple times our original investment. And sure enough, there's no upper limit, right? Some stocks can go up. There's literally no limit on how much a stock can go up by. So the reason here you have a relatively large number of stocks that are at 2,050%, in other words, more than 20.5 times the market return, is because obviously some companies went up by 100,000%, some companies went up by 5,000%, etc. But basically they brought up all of those companies, anything that is at 2,050% or more above the market average ended up in this last category here. Now, if you were to add up all of these companies combined only make up about 7% of all companies, right? So the extreme winners are only 7% of all companies or all stocks, right? So it's incredibly difficult to pick the best stocks. And even when you're picking all of the stocks at the same time, I just showed you on the previous slide that you're losing a substantial amount of your return, or you're missing out on a substantial amount of your annual return if you're missing the top 10, 20, 15, etc., 50, etc. days of the year. So it's not only you should be picking all the companies or the correct companies, but it's also you should be invested for as long as possible, right? And now the key thing to look at this, to take away from this, is that a significant portion, more than half of the companies, have had a less than 50%, more than half of companies underperform the market by at least 50% or more, right? Now, specifically from the same report, and for those of you that weren't here in previous sessions when I was talking about this, here's the link one more time to that particular report. Again, it's one of my favorite reports because it's so detailed and it goes into a lot of very interesting, covers very interesting facts and figures. So again, this is where I took that information from. So you see some extreme winners are around 7%. In case you're wondering, how did I figure out that those numbers are 7%? Well, it tells you in the report itself, right? And the median stock underperformed. The median stock, so 50%, at least 50% of stocks underperformed the market average with an excess lifetime return of at least of basically 54%, right? So in other words, at least 50% of stocks trailed the market average by 54% over 35 years. Furthermore, 2/3 of all excess returns versus the Russell 3000 were negative. In other words, 66% of stocks were actually at least somewhat negative compared to the market average, right? So close to 70% of stocks weren't able to at least match the market average return. And then here, 40% of all stocks were negative returns. And furthermore, 40%, if you're looking at the number of stocks that actually experienced a catastrophic loss, which they here define as a drop in the stock price from peak by of 70% or more. So some of those companies went bankrupt, and some of them recovered, but with minimal recovery. Minimal recovery, very important. So some recovered, but very negligibly, not by a lot. Okay, so what does this mean? Well, you have a 7% chance of picking an extreme winner. That's what that means, right? So 7% chance of picking extreme winner. You have a 40% chance, roughly, of losing of having a minus 70% return over 35 years, regardless of industry. And you can see the different industries. Some are even higher risk. For example, telecom industry and IT. Those are the two highest risk ones. So 57% of IT stocks have dropped by 70% or more with minimal recovery over those 35 years. And then 51% of telecom stocks dropped by 70% or more with minimal recovery over those 35 years. And keep in mind, the average person works about 40 years, right? So this is pretty much an entire working lifetime of investment growth, right? So we would all love to pick one of these 7% of extreme winners. The reality is, though, it's incredibly difficult to do, even for professionals that do this for a living and do this full time, right? So you have a 40% chance of basically picking an extreme loser. And then you have about a 66% chance around to not beat the market average. If you're picking individual stocks, right? So given all of this data, it becomes more and more, obvious and clear that for the vast majority of people, one of the best things you can do is just buy an index or a number of ETFs that make up that follow different indexes, and just stick with that and stay invested for as long as possible. That way, you're not missing out on those best days. All right, last little thing that I wanted to mention to you. So there are certain disproportionate returns. So just because you're investing in, let's say, the NASDAQ, those are the largest tech stocks in the US, or you're investing in the S&P 500, those are roughly the 500, I think 504 currently, largest stocks in the US. It doesn't mean that there aren't some disproportionate returns. So what does FAANG stand for? Well, FAANG is Facebook, Amazon, Apple, Netflix, Google, and Microsoft, right? So some stocks do account for disproportionate returns. Those specifically are the ones in that particular index. So if you're looking at the S&P 500 or if you're looking at the NASDAQ, those are the 6 stocks that represent a lot more of that particular index, or impact that index a lot more than, let's say, some of the other companies that make it up, right? So for instance, let's have a very quick look at Facebook's performance. All right. So we can see here that if you're looking at Max, so we can clearly obviously see Facebook started trading sometime in, I believe it was 2012. Yes. So it was in spring 2012. It started trading around $20 to $30. So yeah, it started about 30 and then dropped to the mid to high teens, around $20 for a little while. And then it slowly started, for about a year and a half. And then it started going up from there, basically, right? But yeah, so in recent times, in recent years, it's really been on a big increase. So here, obviously, we have the drop from when we started having the shutdowns due to COVID and whatnot. So yeah, obviously, then the bottom of the market was indeed reached around the 23rd of March. As a matter of fact, for it is actually the previous week, so the 16th of March. Most stocks, the bottom was on the 23rd of March, basically. But yeah, since then, Facebook has had a very, very nice, or some might even say a phenomenal year. As a matter of fact, if you're looking at the year to date, Facebook has returned 28.53%, which is, quite respectable in all things considered. And if you're looking at our last 365 days, then you would be up 46.84% with Facebook alone. But even with Facebook, had you missed those key days, like for example, even like the more recent ones here, where you had these massive increases in price, the increase would not have been that much, that substantial by any means. All right. So as I was saying before, those stocks are part of the NASDAQ and the S&P 500 in most cases. Here you can actually look at the return of the NASDAQ over the last, here you go, over basically the last, 40 years or so, 50 years almost, for 50 years since 71. And we can see that, yes, the NASDAQ last year went up by just over 35%, which is, very, very respectable as a rate of return. But again, did all of the stocks making up the NASDAQ account for, contribute equally? No, of course they didn't. So what you want to do is you want to look at, and I'm using the NASDAQ and the S&P 500 here just because it's kind of an easy example to wrap your mind around. And also, you've probably, pretty much everyone has heard of these companies here. But the same sort of fact that certain companies will drive certain indexes more than others is very, very much true. Except for, one of the, I guess, notable exceptions would be if you're buying an ETF or an index in any other way, shape, or form that is equal weight. So in other words, all of the shares in let's say it's an index that is made up of 100 different shares, and 100 different companies. Every single one of those companies only contributes 1% to that index, right? So those would be equal weights, and basically adjusted like that. But yeah, so here we have Apple. It makes up 13.16% of the NASDAQ. Amazon makes up 10.7%. Microsoft 10.62%, and so on and so forth, right? So we see this relatively large discrepancy there. And obviously the NASDAQ is made up of roughly 100 different holdings. Here, the reason they have 103 is because this is Canadian hedged. And by being Canadian hedged, it basically allows you to, they also hold some US and Canadian cash to offset any currency fluctuations between the Canadian dollar and the US dollar. And if you want to play around with just, see more information about this, have a look right there. All right. Okay. And finally, let's have a look very quickly. Again, the S&P 500 pretty much does the exact same thing over here in terms of how this fluctuates and how different companies will impact it. So yeah, the S&P 500, we can also see, again, over time, the rate of return of the S&P 500 is around, if you were to average it out, over... Here's the median, right? Is roughly 11% or thereabouts. With worst case scenario, you're losing 38%. Best case scenario, you're gaining about 34% or thereabouts, right? But again, an average diversified portfolio will underperform the S&P 500 just because you also have some bonds and a few other things that are safer, obviously. You might be tempted to say, well, in that case, why don't I just buy those top 5-6 stocks and just, forget about the rest? okay, that would be an approach. Sure, you would outperform the index at that point in time. But keep in mind, the more you concentrate your assets in a handful of companies, and the more you increase risk. So for some people, that might be a better choice. But for many, again, especially if you don't tolerate risk very well, etc., probably buying the entire index and buying a few indexes, so as I said, buying a bit of Canadian, buying a bit of US, etc., 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 is probably going to be better in the long term. And very last thing over here for today, let's just have a look at, to what extent do those key stocks contribute to the S&P 500, because keep in mind, the S&P 500 has about 5 times as many stocks as the NASDAQ, right? NASDAQ holds about 100 different ones. The S&P 500, about 500-ish stocks, right? So here you can see it's 504 currently. Okay, and this one is not Canadian hedged, so the extra 4 stocks are not, or the extra 4 positions are not US and Canadian currency necessarily, although they might still have a little bit of US currency. But yeah, so there are about 503, 504 US listed companies making up the S&P 500. And again, because those companies, because there are 500 different companies, obviously Apple, Microsoft, Amazon, Facebook, Google, etc., despite the fact that they're, overrepresented here, right? Because if every single company would be represented equally, then, 500 divided, 100 divided by 500, that would give you roughly 0.2% per company for it to be equal weights, which is obviously not the case over here, right? So those companies are also overrepresented. Actually, I'm not sure why it messes that up. So you can see, so Apple makes up about 6.5%, Microsoft 5.5%, etc., etc., etc. But same thing, same there, right? So those companies will have a disproportionate impact on the average market return. That's why you want to have a few indexes. That way, you might have 4, 5, 6 important companies that impact index number 1, and then you might have 4, 5, 6 other companies that impact more index number 2, and so on and so forth. So if you have 3 or 4 or 5 different indexes, at that point in time, you realistically end up with between 20 and about 30 different companies that have a significant impact on those subsets of investments. And you also end up with hundreds more companies that are there to kind of soften the blow, as it were, right? And even if you were to have the correct distribution, missing those key dates actually significantly lowers or eliminates most of your gains, as I've just shown you before. So again, that's pretty much it for today. I'm trying to make these shorter because I usually tend to ramble on and on and on. So I'll stop talking here. I hope you found this interesting and useful. Yeah, I'll be posting some new videos coming up real soon. I've been working really hard on them during the summer. Just been delays, a lot of work. But yes, I'll start finally posting those short videos that I've been talking about for the last couple of months soon as well, on top of the weekly live stream. So I hope you found this interesting and useful. And yeah, I'll see you next week. And if you have any questions, obviously, as always, leave them in the comments down below. I'll be more than happy to answer those. And I'll make sure to paste all of the links I shared before in the description of this video once I upload this. All right. So thanks for coming, and have a great weekend, everyone. And enjoy the long weekend, actually.